in a weird way. So there's I think, stunning article in TechCrunch just 2 days ago that said that Tiger Global, which the hedge fund, as of the end of April, the hedge fund had lost about 45%. And then the first weeks of May have been even worse. So who knows what they're at now. But they had a separate venture vehicle. And their history of their venture vehicles is that they raised 3.75 for a fund in 2020, then 6.65 billion in 2021. And then just this year, they closed a $12.7 billion fund in March. Now, I think that fund was raised as early as September last year, but maybe there's some money that still trickled in, and they finally closed it in March. But basically, what this article said is that this $12.7 billion fund that they just raised is already nearly depleted. It's something like 2/3 of the fund has already been deployed. So this idea that they've got like a lot of dry powder sitting on the sidelines, I don't think they do. And then meanwhile, the other big crossover funds, D1, Co2, they are completely risk off. I don't think they were ever as aggressive as Tiger, so they're not in as bad shape as Tiger, but they're just basically sitting on the sidelines till this thing sorts itself out. So basically, all of this capital that flooded the venture markets, this growth capital that came in over the last couple of years, it's gone. I mean, that's basically dried up.
Why did they go so fast, Axe? What was their thinking? Because you and I met with these folks. We saw them marking up our companies because you typically do a Series A. That's your sweet spot. I typically do seed into Series A. You do A into B. They were coming in and marking up in the B and C rounds. What was their thinking? What was their mistake here?
I think the thinking was that we can create an index fund for pre-IPO tech companies, for sort of late stage private tech companies. The only problem was, and by the way, they did I think they did a good job sort of productizing that solution. I mean, if you send them your numbers in a certain format and do a meeting, they were like a term sheet generator. I mean, they spit you out a term sheet in a couple of days.
Wasn't that your original idea, Chamath? You had funding as a service at one point?
I did this thing called Capital as a Service, where you would send us your data, or we would plug in to whatever you use, say it was Stripe or Shopify. We would suck out the data. We would run it against a bunch of models. We would do a few simple regressions, and then we would just index you and then send you a term sheet. So we did do that all around the world, but we did it on very small dollars. We did it at $500,000 checks, $250K checks. It was called Capital as a Service. It's still a phenomenally good idea, but you would want to cure that business for probably 10 years. I would want it to do that on 10 years on my own money, 10, 15, 20, 30, 50 million bucks before I would even dare raise LP money around that idea, because at that point, it's the machines doing the work, and you have to really be sure your models are right.
So you asked the question sort of what was wrong with it. I think that the thing that was wrong with it actually was just that the public comps were all wrong, right? So they were modeling to the public valuations. These are hedge fund guys, right?
Their output was wrong, yeah.
Well, no, look, they're hedge fund guys. So they're looking at the public valuations. They're looking at the last private rounds, and they see a large spread, and they're like, we can arb this. So they go in with a massive amount of money, create a term sheet generator, and they arb the spread. The problem is that all the public valuations we now know were inflated. I actually think they did a reasonably good job in creating a great approach for founders who want late stage capital. If the valuations had been correct, I think it would have worked.
Here's the problem. Yeah. Right now, Peloton and Coinbase their market caps are trading at lower than their last private market valuation. So let that sink in. Like, if you did that last private round, you're underwater big time in those names. Or I don't know if Coinbase
but they were taking their signals from the public markets. Yes. And this is the problem with the Fed and the administration and Congress basically flooding the zone with all this fake money, is that it distorts all the signals in the economy.
Yes.
And then people start making investment decisions that don't work. And then you have this massive correction.
How long have we been doing this, Chamath? How long have we been overfeeding the market? It was obviously happened under Biden and Trump. Did it go back to Obama or no?
Yeah, it started in 2008-9 with TARP,
the bailout,
Troubled Asset Relief Program, which is basically a fund, to create market liquidity, essentially. But what it also did on the heels of the great financial crisis was we introduced comfort around this idea of quantitative easing, or having what's called the Fed put. You may hear that a lot. What does that mean? Which is that when market conditions get too, stiff or rigid or inflexible, the Fed will generally step in with liquidity, typically into the credit market, never into the equity market. But what that does is that also still flows into the equity market. So everybody behaves like there's a downside price at which the Fed is guaranteed to act. And that really started to be a bailout. That really started to be in people's psychology after the great financial crisis. And then through the 2010s, we had several instances where we had that, where we had moments of sort of like market volatility. And all along the way, what we also had were academics that started to promote things like modern monetary theory, this idea that, money printing was a good idea. And so we had this, again, very reflexive loop where, anointed experts, did talk pieces and thought pieces and books, and then pseudo intellectuals would parrot this stuff. And then, the government infrastructure would behave like this was a reasonable thing to do. And it built on itself for a decade. So we've been doing this for 13 or 14 years now. And now we're trying to undo it and put the genie back in the bottle. And it's proving much, much harder than we thought because people have unfortunately got addicted to the crack. They're addicted to the drug. You're trying to take the oxy away. And and people are going to go through
withdrawal.
Really, really bad withdrawal.
Yeah.
If you have $250 billion of dry powder, let's assume no one gives their money back and they don't do stupid stuff like chase losing companies in their portfolio, and they allocate it in a smart way to winning companies. Does that not mean that we end up seeing a significantly kind of outsized amount of capital going to a few highly successful businesses, that we'll end up seeing this kind of supercharging of a small set of businesses as opposed to this rise of the unicorn, which is what we saw over the past, call it, 7, 8 years, and that you have this big bifurcation in the market. The VC market starts to kind of say, hey, you're not making money. You don't have a line of sight to making money. You're off the table. But the top decile get overfunded and they become kind of the next mega caps.
No.
Yeah. I mean,
it does not happen in this moment.
Well, so look, if we look ahead 2 or 3 years,
can I just tell you why? Let's take the perfect company, which is Stripe. Okay, so now $50 billion. Well,
they've been funded to a mega cap, right? I mean,
$50 billion of horrible VCs who've made horrible decisions heretofore, knocking on the Collison's door saying, can you please take my $50 billion because I'm trying to be money good. Why do the Collisons want to take on this headache? Why do they want to set their cap table up with all these folks? And then at what price? So if you're sitting at the board of any really good, well-run company, of course you'll take some bite-sized, amounts of very decisive capital in these moments if you think you can market consolidate or whatever. But I think the point that all of these companies are going through is largely the same. If the best companies aren't doing what we just talked about, I would be shocked as well. The best companies are thinking, let's batten down the hatches and let's not distract ourselves. And so I'm not sure that this is the moment where a really horrible VC who's had a terrible track record, who've just blundered through $5 billion, is going to be able to put in $1 billion to Stripe.
What do you think, Sachs?
Let me speak to kind of the environment that I think is going to happen over the next few years and what founders will succeed. I think you're right, Freeberg, that the VCs are going to become much more discriminating, and there's going to be a much more polarized outcome here for companies. I had a tweet storm that Elon actually gave a nice boost to by saying he agreed with it, where I basically said, look, startups with high growth and moderate burn will get funded through this downturn. Startups with moderate growth and high burn will not get funded. So what's going to happen is that the sort of mediocre ones are we're going to get to a very polarized outcome very quickly where, I think a lot of founders think that if their numbers are just okay and not great, then they'll be able to raise, but at a lower valuation, or they'll be able to raise something, but maybe not as much as they wanted. And what will happen is the middle cases kind of go away in an environment like this, and everyone just wants to fund the best companies. So certain things will become absolutely fatal for startups in this environment. One is obviously if they're just not growing, they're not going to be able to raise. And good growth really starts in the early stages in terms of doubling year over year. Second, negative or low gross margins are absolutely fatal. Nobody wants to fund businesses that may not even be real businesses. And I would say acceptable gross margins really start at 50%. Third, CAC payback. People want to know that you can pay back your customer acquisition costs in a year or less. And then, like I mentioned, the burn. A burn multiple of 1 is really ideal, where you're burning not more than your net new ARR. but certainly not more than 2. I think burn multiples over 2, where you're burning $2 to add $1 of growth. That's where I think, companies start becoming unfundable. So I think founders are just going to have to pay a lot more attention to these disqualifiers.
Yep.
But I think that for companies who meet the criteria, who have good growth, low burn, good business fundamentals, they will be able to raise. And look, here's what's going to happen. The crossover investors are washed out of the system. They're gone. I mean, Tiger's already deployed all of its capital, and I don't know when they're going to be back. So the so-called tourist money, basically the big investors who weren't in the system a few years ago, they're basically going to leave the system. However, there will be the big traditional venture funds will have large funds, but they're going to deploy them much more slowly. These 1-year pace of deployments, they're going to stop.
Back
so
to
the
3.
funds they'll be back to 3. Exactly. So just think about that. Even if you had the same amount of money being raised and deployed, but it was happening over 3 years instead of 1, that would be a 2/3 reduction in the availability of capital in the system.
So who's that going to go to? You're not putting that
to
in
the best companies that I'm talking about.
You're not going to go to somebody who's going to blow through it in 9 months, who's playing every hand. Like, you cannot play that way anymore.
Exactly. So what we're telling our founders is, number one, you got to lengthen your runway. Like, the days of raising a new round every 12 months are over. You got to plan on not raising for 2 to 3 years if you can help it. And then you really have to sharpen your pencil and work on these business fundamentals. And, one thing you need to do is you need to have a realistic conversation about, am I really able to raise another round in this environment with the metrics I currently have? And if the answer is no, you need to cut your burn to give yourself the time to fix the business. And that fixing a business normally takes 2 to 3 years. So, if you got less than 2 years or even 2.5 years of burn, and you have one of those disqualifiers I talked about, you better cut your burn quickly to give yourself the time to fix those disqualifiers.
Yeah. I mean, I wish we've been talking about this for a year, folks. And, some founders just are not accepting the reality of the situation. And if you look at what happened, we have a generation that's never experienced a down market. And these down markets happen so violently that they think like people are panicking. Somebody made a joke, like Bill Gurley's called 5 of the last 3 recessions, and it's like, well, I mean, we have scar tissue, and it's that the velocity of the downturn.
All those kids dunking on Gurley. Well, guess who's going to have the last laugh? I think
precisely. I texted Gurley last night.
He's had the last laugh for 30 years.
I literally DM'd him last night. I said, listen, the water's great right now. I am doing deals back at $6 to $12 million in the seed space with, $200K in revenue and real founders and discipline. Start investing again. It's great now because the deals are now taking, I don't know if you're experiencing the Sachs, but the deals went from taking 2-3 days. Now they're back up to 4 to 6 weeks. And we're having very thoughtful discussions. We're meeting a third time with founders. We're talking about their go-to market strategy. We're getting to talk to 3 or 4 customers. I had founders who said, you can't be in this deal if you want to talk to my customers. And that wasn't one founder. Multiple founders said, if you want to talk to our customers, then you don't get an allocation. And I said, okay.
The thing to keep in mind,
I won't do the deal. But that was how dysfunctional this was, Chamath.
The thing to keep in mind is that all these late stage companies are mispriced. Doesn't matter whether you're the bottom decile or the top decile, you are massively mispriced. And there needs to be some correction between 30 and 70% on valuation, 30 and 90%.
How do you solve it?
I have a point of view on that, actually, because so look, there's a major difference, I think, between a valuation multiple collapse in the public markets versus the private market. It's gone down. Look, the SaaS valuation multiples have gone down 70, 80%. There's no disputing that. If
what
it went
are
down, look, it used to be the public markets were trading at 15 times ARR for the median SaaS company. Now it's 5.6. So yeah, we're talking about 2/3, 70, 80% reductions. If it had happened in the public stocks, it deserves to happen in the private stocks too. Chamath's absolutely right about that. And a lot of people aren't recognizing that fact. However, here's the difference. The median SaaS company is growing maybe 15 to 20%. When you've lost 80% of your value and you're only growing 15 to 20%, it's going to take you a decade to grow back into your old valuation. However, good private companies, not all of them, but the great ones, they're still growing 3x year over year. So if you're able to grow 3x year over year and you do it 2 years in a row, you're 9x where you were. Even if the ARR multiple collapsed 80%, you can still get an up round. It's not going to be a 9x up round. It might be a 2x up round.
I know how that's mathematically true, but listen, if you're 100 million ARR business. Let's just say you were able to raise at 10 or 11 billion. Yes, you're mathematically right that 100 million times 9 is 900 million. But I think it's important to first say, how many actual software companies are there that generate $1 billion of ARR? Do you remember when Salesforce first passed $1 billion of ARR? We thought, my gosh, and then they said, we're going to get to 10 billion. So this is exceptionally rare air. And I think that it behooves people to understand that law of large numbers aren't often violated. And so, before you go and do that simple math and convince yourself that it's possible, maybe you should actually, I'm not saying that to you, Sachs, I'm saying that to the founder or to the boards. Maybe you guys should actually just go in and have somebody run a screen and say, how many actual companies exist that have actually managed to generate more than $1 billion of ARR, especially in a moment where people are cutting back on spend? How does that happen? So
yeah, I agree. Getting from 100 to $1 billion is really hard. If you're getting
$10 billion company supposed to do, because in this math, they have to get to $2 billion of ARR to be worth 10 billion.
I do think a lot of
how do they do that? How does the random SaaS company that you and I have never heard of, how do they generate 2 billion of ARR? I can tell you the handful of companies that generate 2 billion of ARR. There are some incredible companies today that don't even yet. Like look at an incredible company like Unity. Incredible, the backbone of all, gaming and, the move to 3D. This year, if they crush, they'll do 1.3 billion.
Incredible business.
It's an incredible
it just went down 35%. It just went down 35%. It's unbelievable.
It's trading at 4 times revenue, guys.
Right.
So some of these things are hard to believe. Like Opendoor has 2.3 billion in cash and a $3.7 billion market cap. Enterprise value 1.4. And I think they also have a couple of billion in real estate. Coinbase, $6 billion cash, $12 billion market cap. So I guess in this part in the discussion, even with all these headwinds,
can we give the protective mechanisms for employees? Because yes,
okay, good point.